Okay, so you build a state-of-the-art flying taxi to completely revolutionize human transport, and your entire corporate timeline gets derailed by, well, 45 straight days of English rain.
Yeah, an incredible piece of advanced aerospace engineering entirely defeated by mud and overcast skies.
Right. So welcome back to Earnings Unscripted. It is March 24th, 2026, and today we are looking at Vertical Aerospace, ticker EVTL, and their Q4 2025 results. Just real quick before we really get going, this podcast is strictly our personal opinions, definitely not financial advice. Do not go trade flying car stocks based on what we think here.
Definitely not. You would need a much better weather forecast for that anyway.
Fair point. So to set the baseline here for the quarter, revenue is zero, which we completely expect for a pre-revenue startup. But the burn rate is the story today. Operating loss expanded to a £47 million deficit, and that is up roughly 54% from Q3. The stock just took an absolute beating on the tape, opened at $3.50 and just bled out the entire regular session to close down almost 18% at $2.88. Mira, what is your read on that market reaction?
The tape is screaming that the clock is running out. Look, the market sees a company trying to sprint while someone is crimping their oxygen hose. They swung back to a $41.9 million net loss in Q4. Q3 only looked profitable because of a massive paper write-down on their debt liabilities. But the cash reality is harsh. If you look at their balance sheet, cash and equivalents shrank 25% just since Q3. They are sitting on £69.1 million at year end.
Which, sounds like a very solid bank account until you realize they're trying to build actual aircraft prototypes.
Exactly. R&D expenses alone jumped roughly 68% to $30.8 million this quarter. They are actively building the second and third full-scale prototypes, expanding the flight test envelope. That is inherently expensive. But the thing that really spooked the market today is not the operational burn. It is the formal warning. The PCAOB auditor literally stamped their filings with a substantial doubt regarding going concern.
They actually admitted in the filing they project breaching their $10 million cash minimum on their debt covenant by mid-2026 if they do not raise new capital. That is essentially tomorrow in aerospace development time.
Yes, and that is where the psychology gets interesting. On the earnings call, management was projecting this very relaxed attitude. CEO Stuart Simpson literally said they do not feel under pressure to raise capital immediately. But then you read the 20F, and the math is staring right at you. The runway is ending. If they breach that covenant, Mudrick Capital can accelerate maturity, and that triggers a default.
And to make it even tenser, they just got hit with a surprise lawsuit from a direct competitor, Archer Aviation. They filed it a month ago in Texas. Just a massive shot across the bow over design and utility patents right when Vertical desperately needs to show strategic investors they have a clean, clear path to commercialization.
Whether the tax has actual technical merit almost does not matter yet. Defending a patent case in a Texas federal court is incredibly expensive. It is a fantastic way to torch whatever little cash runway you have left.
Right. And then you add the weather back in. I still kind of cannot believe this detail. They need this critical transition flight test to be successful so they can unlock that next wave of strategic funding. And they lost 46 days of test flights because they literally are not legally allowed to fly the prototype drone in the rain.
It is the ultimate irony. They built this beautiful, efficient local UK supply chain to speed up manufacturing, and it turned into a geographic trap. They are physically grounded.
It is wildly frustrating. All right, let's get into the details.
The detail that actually caught my eye in all this doom and gloom is what they are doing with the airframe, the Valo chassis. Because you look at the cash burn and the weather, and you think this is just another doomed urban air mobility play. But they essentially stumbled into a massive defense contract pivot.
Wait, really? A defense pivot? I thought this was supposed to be the shiny electric Uber in the sky.
Right. That was the original pitch, but at an aviation trade show recently down in Atlanta, they realized the Valo has this unusually large baggage bay. So they told the military attendees, look, you can just unscrew the electric battery packs from the bay, drop a traditional gas-powered turbo generator in there, and instantly you have a hybrid drone.
You just unscrew the battery and drop in a gas engine? That sounds like tinkering with a toy car.
It is essentially modular tinker toy aerospace, and because of that hybrid setup, the range jumps to over 1,000 miles. They can carry 1,100 kilograms of payload. That completely dodges the massive weight limits that pure battery tech struggles with right now.
Which is exactly what the defense market actually wants. Distributed, heavy logistics that do not need a runway.
Exactly. And the military buyers were apparently shocked because usually it takes a startup 5 years to engineer a hybrid variant. Vertical just uses the exact same carbon fiber frame. Their chief engineer, David King, literally said on the call, whatever they were forecasting for the defense market, people are telling them they're not forecasting high enough.
That is a huge narrative shift. Because suddenly you're not banking entirely on consumer adoption or, waiting for cities to build thousands of civilian landing pads. You just sell straight to the government.
It changes the total addressable market overnight. It's a completely different business model.
Okay, but bringing it back to the pure electric side for a second, the batteries themselves, there was something in the transcript about battery degradation that honestly blew my mind.
Oh, the replacement cycle. Yeah, this is brilliant if they can actually pull it off. So aviation safety is brutally strict. Once an EVTL battery degrades to about 93% capacity, it is no longer flight-worthy for vertical liftoffs.
Right, which sounds like a massive product flaw at first glance. But they flipped it into a recurring revenue model because 93% means you have to replace the battery roughly every single year.
Per airframe for an expected 20-year lifespan of the aircraft. So they are essentially building a razor and razor blade model, but for aerospace. Stuart Simpson, the CEO, called it a long-term predictable revenue stream. He guided to circa 40% margins on those replacements.
40%? That is... you do not see SaaS margins in heavy metal OEM manufacturing very often. And I love that the CEO actually ran the battery production line himself recently. Like, he was physically on the factory floor doing the process steps.
He has to be. That battery energy center is their golden goose right now. And they're even planning to take those used 93% batteries and resell them into secondary markets. Things like stationary grid storage or marine power.
So you get paid for the initial aircraft, you get paid every year for the mandatory replacement battery, and then you get paid a third time selling the degraded battery to someone else?
It is a phenomenal cash flow loop, assuming, of course, you survive long enough to manufacture the first commercial unit, which brings us right back to that ticking clock on the $10 million cash minimum.
Right, the existential threat hanging over the brilliant engineering. So, looking at this incredibly tight runway and all this hidden potential, where does this actually leave them heading into the next few months?
They are accelerating right into the wall. Management guided to spending roughly $190 to $200 million over the next 12 months. They actually plan to open 2 new manufacturing plants and finish assembling the first commercial Valo aircraft.
Wait, sorry. How do you spend $200 million when your balance sheet only has 69 million pounds left on it? The math just does not work there.
It requires a lot of creative confidence. But look, to be fair, they do have backup options. Stuart Simpson literally said on the call, and this is a quote, "We are pretty comfortable as we sit here today." He claims they have a clear line of sight to about $150 million in liquidity, plus a completely untapped $78 million equity facility.
Comfortable is just such a wildly strong word to use when your auditor is raising a substantial doubt warning. It feels like they are completely betting the farm on executing that final transition flight.
That is the crux of the whole company, right there. Their entire future trajectory rests on the next few weeks of testing. If they nail that horizontal transition maneuver, they prove the core engineering and unlock that new strategic capital. But if they stall, or if the rain just keeps falling, they probably breach that debt covenant next year, and Mudrick Capital gets to seize the keys.
It is almost a movie script at this point. You have this brilliant hybrid military drone, these totally novel battery economics, a looming Texas patent lawsuit, and all of it is quite literally hostage to the British weather.
They should really allocate some of that remaining cash to a very large umbrella.
Honestly, they probably should. All right, we are going to be watching the skies closely for this one. Thanks for tuning in, everyone. We'll catch you after the next call. And hey, if you like having these breakdowns just waiting in your feed, you can go ahead and follow the show. Just as a quick reminder, we do use AI to help generate this podcast, mostly to read through those massive regulatory filings so we can get straight to the interesting parts. We'd love to know what you're watching, so shoot a ticker request over to earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for hanging out with us. Catch you next time.
Take care.